All right. Well, good evening, everybody. Thanks for coming. My name is John Mazzara. I'll be presenting tonight. I am recording this. We are going to send out a replay to everybody that attended and those that didn't. If you have any questions, make sure that you ask them. I want to make sure that we give you everything that you came here for. I've been doing this a long time, so let me tell you a little bit about myself. This webinar is about buying a home and specifically for first-time home buyers. So I've been in this business for a long time. I started when I was 21. I've been selling homes for the past 39 years. In addition, I've been a financial planner for the same amount of time, approximately about 38 years. And my wife and I had a mortgage company for almost 25. So my background is varied and broad, all through vertically integrated through the financial industries. And so I can add a lot of value, to your lives in multiple areas. So again, wherever you have questions, let me know. Oftentimes, as a first-time buyer, because you haven't done this before, and I've done it about 1,200 times, you don't know where to start. And so I commend you for coming here, getting some information. Maybe you're feeling concerned, stressed out, intimidated by the process. Maybe you're anxious or uncertain and don't know where to start. So I'm going to add clarity so that by the time we're done tonight, you'll know exactly what to do. So here's me. Again, I started selling homes. I went to St. John's University, which is up by St. Cloud. I graduated in '86. I've sold homes on both sides of the river. I work both sides, and I teach community ed also throughout many different communities, about 10 different communities. So I work, and I'm very familiar with both sides of the river, and I work with buyers, sellers, and investors. I'm very familiar with all the mortgage programs and lenders. So my wife works over at Wells Fargo, but she is not the only lender that I work with. I work with a number of mortgage brokers and other people that can bring different mortgage programs to the table. We're going to talk about some of those tonight as we go. My goal is to help you buy the right home. And when it's the right home, you'll know. It's kind of like falling in love. You just know. And the home buying process, even if we try to make it, I'm going to say more mechanical, it really is a very emotional process. So you can Google me and check me out. I have plenty of references and reviews. Like I say, I've been doing this for a very long time. So what does an agent do for you? So there's been some changes you may have read in the paper about the lawsuit that was against the National Association of Realtors and how that was settled. I'm going to address that when we get a little further on, but an agent does a lot of things for you, and here's 111 things that they do that you may not really be aware of. So we do a lot of things that are behind the scenes, if you will, and make the process easy for you, but these are kind of the steps broken down that we do. When you work with an agent of your choice, you're going to be presented with this form here, going over agency. Agency is a description of the duties of the parties that are involved in a transaction. So when you're driving down the street and you see the sign in the yard, that's the seller's broker. Somebody that may help you purchase a home is the buyer's broker. And sometimes the listing agent and the buyer's agent work for the same company. That would be called dual agency, where they have obligations to both parties. Could be the same agent or just the same company. So for example, if I worked with you and I showed you when you bought a Remax results listing, I would be a dual agent. Same thing if you're working with Edina Realty, buying an Edina Realty listing, or Coldwell Banker, buying a Coldwell Banker listing. So if it's the same company, it's dual agency. Another way that we can work with people is through what's called facilitation. So maybe you have a friend or a family member and you'd like to buy their home and they'd like to sell it to you, but you don't know where to start. And then that's when you would seek out somebody to do the paperwork for you. They don't have any representation duties, but they do the paperwork according to what you've agreed to. Also, you'll note on the bottom in big bold letters about predatory information. So if you were concerned about the proximity of somebody living next to you that had a sexual predator record, you could go to this website and or call the phone number and find out how close they are. That is a non-disclosure item on behalf of the seller. So if that's a concern of yours, all buyers are given the website and phone number for them to do their own due diligence. Again, the seller does not have to tell you. After agency, the next thing that you'll be presented with is a contract for representation or a showing agreement. So this is kind of where there's been some changes most recently. A contract for representation can be exclusive or non-exclusive, or it can again just be a showing short-term arrangement. And basically what you're agreeing to is allowing an agent to work with you on your behalf. There will be some form of a charge. However, the seller may agree in your purchase to pay your charge. So in the old world, and that was pre-August 17th, in the old world, everything was bundled and we had transparency in the sense that on the MLS, which is the multiple listing service where homes are listed, compensation was disclosed and we would all know. Now it's something that we have to find and seek out either on a different website away from the MLS or with a phone call or email to the agent. This is so new, it's just a couple of days old. But what I'm finding in my own experience is that the sellers, when they list the home, do want people to show their home and they are open to paying the compensation that your agent is asking for. So for example, under line 30, where it says that you would pay, let's say 2.7%. In the purchase agreement on line 406, your agent would most likely ask for that same 2.7%. So the seller would be paying it at the time of the closing like they did under the old agreement. It's just that it's unbundled and now we're separating and bringing it back. Minnesota is one of the states, in my opinion, that did a really good job of previously already showing everything transparently. Other states, because this was a national settlement, maybe didn't do that. I think the lawsuit originated out of Missouri, and I'm not familiar with what their forms were, but now everything is kind of operating under the same agreement to coincide with the new lawsuit. So anyway, real estate will continue to work with buyers agents and sellers agents, and it's just another little step in the process as we adjust to it and do the paperwork. But you will, before you can look at a home, have to have an agreement, either exclusively, non-exclusively, or a showing agreement. You can't walk into the home unless it's an open house, of which then you could. But otherwise, to have an agent walk you through that house, you're going to have an agreement. That's a little different than it was before because before we didn't need to have that to show you the home. Now we do. Here is a website that you can go to and you can get data. Now this data comes from the multiple listing service, and I pulled up the most current one. It's always 1 month behind because the data has to have occurred for the report to be created. This report here, you can find at mplsrealtor.com under the Market Data tab. So if you were to go there, hit Market Data, you'd be able to do a drop down and you could go macro, like we have here, where we're the 13 counties, or you could go micro. Maybe you have an interest in Edina or a certain neighborhood in Minneapolis or St. Paul. You can drill down and get the data. I'm going to highlight 3 areas here for you. The first one is median sales price. So from July of last year to July of this year, the price went from 379, 945 to 386. That represents about a 2% increase. If you run your finger across and you kind of want to smooth the data, you get a rolling 12-month number of from 365 to 375. That's about a 3% increase. So homes, the appreciation rate in the Twin Cities is approximately equal to what you might be receiving in the form of an annual salary increase. If you look at the percent of original list to sale price line, you see that homes today are selling for just under list price. A year ago, they were selling for just over list price. So if you smooth that data, it comes out to be 99%. In July, it was 99.5. What that means is that if a seller lists their home and prices it appropriately, it's going to sell very close to what they asked for. The last line is months of supply of inventory. We had 2.2 months a year ago. We have 2.5 months now. And what that means is that there's more homes for buyers to choose from. The reason, in my opinion, is because interest rates have been higher, which has restricted a number of buyers from coming into the market or preventing them from qualifying for the home that they want, so they haven't bought. So interest rates definitely have an effect on your purchasing power. The approximate rule of thumb is a 1% increase in rates will reduce your purchasing power by 10%. So imagine 3.5 years ago when rates were 4, now they're closer to, let's say, 7. Well, that's a 3% rise, which is 30% less in purchasing power, assuming that your income, remained the same during that time period. So fewer buyers means that the inventory levels will stay higher. Part of it also is seasonal, meaning we're out of the spring market. The spring market is when most family style homes sell. And then homes, of course, sell every month, but I would say February through June, you'll have the most amount of family style homes to choose from. Family style, I'm defining as 3-bedroom, 2-bath or more. Condos, townhouses, investment properties, they're not as tied to schools, school starting, school ending, like a family style home might be. So they're going to not be as dependent to that spring market. But otherwise, the spring market kind of ends around June. July can be kind of a slow month as people vacation and are involved in sports or tournaments. And then it picks up again in August, and that carries us through maybe October. And then it slows down for various holidays again and the normal inclement weather that we get in Minnesota. So real estate is somewhat seasonal. It's also property type and size dependent. Okay, well, what are the steps to home ownership? Well, one of the first ones is to come learn. Do you know that the average home buyer today is about 36 years old? So that's kind of interesting because back in the day, people were buying and doing lots of things sooner, back in their 20s. They were maybe getting married if they chose to do that and start a family, as well as buying homes in their 20s. Not so much anymore. People are investing more in their career, maybe deciding not to get married or not to have a family. And just everything's a little bit different. And that's translating also into the demand for various types of housing. If you aren't planning on having a family and aren't going to use the schools, then that means maybe you don't want a single family home. Maybe you want more of a condo or a townhouse, and maybe you'd prefer to be, downtown or in a different area. And also with the ability to work from anywhere, maybe you are allowed to work remote and not have to go into an office. All of a sudden, the possibility of living out in the country or on a lake, for example, is a possibility, whereas before you would have to drive into an office. So there's been some structural changes to our society that have impacted people's purchasing choices, when and where and what type. So just kind of interesting. When you want to go out and buy a house, the first step is to make your way over to the lender of your choice and get pre-approved. Now you could get pre-approved very easily, or you could be pre-underwritten, which takes a couple more weeks. I'm going to advise you to get pre-underwritten if your lender will do that. Now, the difference is a pre-approval, somebody puts in your information into the computer, they push a button, and they get a pre-approval letter. But that's only as good as the data of which was entered. So if they incorrectly put the data in and it's not adjusted for example, then after you buy the home and you're in the underwriting process, you may find out that you're no longer qualified for that house. So we don't want that to happen. We want you to be underwritten, which means you've already submitted your pay stubs, your bank statements, your asset statements. The underwriter has reviewed it, the underwriter has approved it, and you're solid at that point. There shouldn't be any hiccups. All we're waiting for is the appraisal and the title work. So we could literally close in a couple of weeks if you're already underwritten. If you're not, we may need to add a couple of extra weeks. You can buy a home in as little as 2 weeks to up to 60 days. Normally, most sellers want to close between 30 and 60 days. So a 45-day closing is very common, and you might want to budget that or plan for that around if you have a lease with regards to your notifications to your landlords. The types of the loans that you could obtain would be a conventional loan, a VA loan, or an FHA loan, depending on your credit and what you're doing. So everybody is eligible for conventional. Everybody is eligible for FHA, again, subject to credit scores, but only veterans are eligible for VA loans. There are many down payment assistance programs today, more than I have ever seen. And the one that I just completed 3 transactions with was the first generation homeownership program. We're going to dig into that in a little bit, but that allows somebody who's never owned a home, or their parents have never owned a home, or their parents were foreclosed out of a home, to be able to get some serious money from the state of Minnesota. One program allows for $35,000 that's forgivable over 20 years at various increments. And then there's one of 32,000 that's forgivable over 5 years. So there really, in my opinion, has never been a better time to buy a home, especially with some of these down payment assistance programs. Once you've been pre-underwritten or pre-approved, we know exactly what you can buy, meaning the type of property and the mortgage amount. And then we set up an MLS search. MLS search is the multiple listing search based on your minimum criteria. So for example, you may say, well, I really want a 3-bedroom home, but I would be okay with the 2. So we're going to set your search up with a minimum of 2 so that we capture all possibilities. And then that's going to be approved by you through the Northstar MLS, and you're going to set up, or we're going to set up an auto drip. So that means as new homes appear that match your criteria, you'll get an email immediately. So one day you might get 1, then you get 3, then you get none, then you get 2, and so on and so forth. After a short period of time, you will be an expert on the communities of which you have an interest, and you'll be able to know a good value, on an overpriced home, underpriced home. And then as the right homes appear and you want to view them, we go out and view them. So that's sort of the procedure. Once you get a home or you find a home that you like, we write an offer. Hopefully we get it accepted. However, if it's a really good home, other people are going to like it, and you might end up in a multiple offer. I had a listing this past weekend. It was in Crystal, and it was a great home. And don't you know, if we didn't get 3 offers, all of them over list price. So the seller selected, the strongest buyer with the most amount of money, and that's the offer that we took. But it doesn't always work that way. Sometimes they'll take an offer because of the financing. They may prefer a conventional loan versus FHA or versus VA. VA and FHA loans are a little more picky with regards to the condition of the overall property. And so sometimes sellers, especially if it's got, some obsolescence or scratch and dent type of stuff going on, they may prefer not to work with that financing, and they may work and select a lower priced conventional offer versus a higher priced FHA offer, just to avoid that possibility of work orders, for example. But once we have a contract and we have it, we've negotiated and bought the home, part of that contract will probably involve a home inspection. Home inspection is where you hire a home inspector, costs $500 to maybe $2,000, depending on the number of additional inspection items that you add. The inspector goes out there, creates the report, and then from that, we can decide if you want to go forward or not, or ask for certain items to be repaired or not, and then we proceed. If you buy a condo or a townhome, you have 10 days to review the rules, the regulations, the bylaws, and all financials. And if you determine that condo living isn't for you, or townhome living isn't for you, for whatever reason, maybe there's no reason, doesn't matter. You have 10 days to change your mind once you've received all of the disclosures. So buying a condo or townhouse is kind of like getting a free look of 10 days. Now, we don't want you to buy and walk away, but you could do that because you're allowed through the Minnesota law to go ahead and take your 10 days. Now, you could shorten it to 3. And if it's a really popular property, a seller may ask you to do that so they can either have you in or out. You're either going forward or you're not. But once you've decided that you're going to go forward and the home inspection is completed, then you give your lender your credit card. They order the appraisal. At the same time, they place an order for title work, and title work determines the chain of who's owned it and if there are any liens. If there are liens, that's no problem. They just have to be satisfied, meaning paid off at the time of your closing. So if the previous owner had a mortgage, that's fine. That's paid off by your new mortgage loan proceeds, and it all happens simultaneously at the closing. When we go to a closing, we sign papers, or I should say you sign papers. You sign about 50 times, it takes about an hour. At the end of the closing, you get the keys and the seller gets the proceeds check. And then you get to plan for which holiday or party you want to host with your friends and family. So that's kind of the procedure. Graphically, it looks like this. So the same thing I just read to you is right here. First step is what you're doing tonight, getting educated, finding out what you need to know. The next step is figuring out what you can afford. You get your mortgage in place, you get underwritten. We go shopping to pick out the right home. We ultimately write an offer, hopefully get it accepted. And then we have the inspection. And after that's done, you complete your mortgage approval process, which involves the appraisal and the title work, as well as resubmitting things like your bank statements and pay stubs. Those have to be updated. And then we close, and again, we have the party. We have another checklist for you, another list that I kind of just went over, but it's listed right here for you. And then we're going to start talking about some of the mistakes that you don't want to make. So mistake number one, if you're a first-time buyer, is to not look into the incentive programs, maybe falsely assuming that you make too much money. One program, for example, in Edina, allows you to be a first-time home buyer and take advantage of some of their funding with an income as high as $150,000. So don't assume that you have to have a very low income. You don't. Minnesota Housing Finance also is fairly large, and they're one of the major providers of down payment assistance. Now, there are other ones that do require that you have a low income, but not all of them. So the way the first-time buyer programs work is that they oftentimes provide you with the money that you need for the down payment and the closing costs. They cover that. So when you close on a home, you have two mortgages. You have one, the main mortgage, and that's either by, conventional lender or conventional loan through Freddie Mac or Fannie Mae, or through FHA, or if you're a veteran, a VA. And then your down payment and closing costs are from the other providers. So like the city of Edina would be if you came to Edina, they have the program, it's called Come Home to Edina. They would lend the money. You'd have a payment associated potentially with that, or the Minnesota Housing Finance Agency. So wherever you're getting your down payment assistance, some is a grant, some is a loan, some is a hybrid. So I'd mentioned the first generation program. It initially starts off as a loan, but the longer you stay there, the more is forgiven. So it just depends which one you're using, but mistake number one is not to explore them to see if you can't take advantage of it. So in general, a first-time home buyer is somebody that has not owned a home in the past 3 years. So maybe you're aware of somebody that used to own a home, then for whatever reason didn't, and they think, well, I used to own one, so I can't qualify for the first-time buyer programs. That's not true. In most circumstances, 3 years is all that it takes to be out of home ownership to be considered a first-time buyer. You normally have to complete specific training, whether it be from the provider themselves, if they have their own class, or it could be online. So it could be Neighborhood Works, it could be Framework, it could be a Habitat for Humanity, it could be another provider, but normally there is a home ownership component, a class that you have to complete prior to getting the money. Now, the first generation program actually requires that you complete some of their education before you can reserve the money and before you write a purchase agreement. Others will let you do it during the process itself, meaning you can do it while you have the home under contract, but not the first generation program. So more than ever, you're going to want to know these rules before you get too deep into the process. Otherwise, you might be eliminated from some things like the first generation program if you don't do the steps sequentially properly. So most classes can be online, or like say over the weekend, they try to make it available when you have time off. You can do them online in various steps, a couple hours here, a couple hours there. So they try to make it real easy for you, but you do have to complete it and get the certificate. A first-time buyer program, they can be specific to cities, counties, or the entire state. The Minnesota Housing Finance Agency is for the entire state. So is the first generation program. All of them are going to be dependent on having a certain level of income, meaning not to exceed, and they are dependent on your credit score. So if you have a low credit score, we may want to improve that before you go out shopping because you're going to need to have a certain minimum under most of the programs. Some might be forgivable, which means the longer you stay, the more that's forgiven. And some just might be deferred, meaning there's not a payment today or even a repayment obligation until you sell the home or rent it. So many of them have that type of a caveat. So it could be a loan, could be a grant, and sometimes they're even stackable, meaning you can use more than one program at the same time. I had a lender use a program and he used 4 programs together to help this person into home ownership. So it depends on where you're buying, what programs are available in that area, and if they are stackable. Here's an example to kind of maybe put it with some numbers to maybe make it a little easier to see. Let's say you wanted to buy a home for $250. You're going to put 3% down under the minimum down payment with a conventional loan. So that means you're going to finance 242,500, down payment of 7,500, and have closing costs of roughly 6,250. So the total amount that you're going to need is 13,750. However, Minnesota Housing Finance will allow you to borrow that amount less $1,000. So if you've got $1,000 and you've got a 640 credit score, you could buy this house borrowing 12,750 from Minnesota Housing Finance Agency and the other 242.5 from the conventional lender. So that just gives you an example of how that gap is bridged. So a lot of people will wait until they have a larger down payment, but if homes continue to appreciate, every year that you wait will only increase the cost of that home. So when is the best time to buy a home? That would be yesterday, because the home is probably cheaper yesterday than it will be tomorrow. Now, homes, of course, will have a fluctuation in value, but that typically is the trend. Interesting enough, right now, with interest rates being a little bit higher, what happens when rates drop? Let's say that rates default to the historical 50-year norm of between 5 and 6. So we get out of the sixes and we get down to the between 5 and 6. You're going to see a lot more buyers come into the market and people's borrowing power will be expanded because remember that 1%, 10% relationship. So the prices then will only get bid up. So I would encourage you, if you have an interest, to buy now and refinance later. That's called date the rate, marry the home. You can always refinance if you qualify. You can always refinance in the future. And so take advantage of the lower rates by refinancing if they drop in the future, but get the home you want now with the least amount of competition. Also seasonally, because there is more inventory now, and because we're going into a slower time as we approach the fall, this would be an ideal time for you to look at buying a house because again, the competition should be less. We have an election coming up and who knows what's going to happen. And, regardless of the winner, I think the world will be somewhat destabilized. There's a number of world events that are going on, concurrently, that could change things. Now, I again have been selling since 1986. So that means I've been through Gulf Wars 1 and 2, the S&L crisis, Y2K, 9/11, the crash of 2007/9, foreclosure crisis. So whenever there's a crisis, people typically don't do anything. But that might be the best time, as long as you don't believe the world is ending, that might be the best time to enter into the fray because you'll have maximum amount of pain in the sense that the seller is very motivated because there aren't a lot of people looking. And, if you believe in that this too shall pass, that's a great time to take advantage of maybe where you will have more negotiating power than otherwise. So when you look at programs and lenders, there are proprietary lender programs at some of the bigger banks, for example, and some portfolio loans at other places, like at some of the credit unions. So again, I mentioned my wife, her name is Patty. They have a program called the Dream Plan Home, where you can get up to a $5,000 closing cost credit. Now, if you work for a union are associated with the union, there's also a program called the Union Plus, where you have special foreclosure protection and you get another, I think it's a $500 gift card. Some of the larger employers also have affinity programs for their employees with some of the larger lenders. So this might be something that you look into. On the other hand, you may want to, and like, for example, let's go back to the Wells for a second. So Patty and Wells Fargo work in conjunction with the City of Edina program and their program called Come Home to Edina. Now, again, that's a program for first-time buyers. Not all lenders will work with the Come Home to Edina program or the MHFA program. So let's say you work with small bank of your hometown, wherever that might be. That small bank probably has not approved or is not approved to work with many of the down payment assistance programs. So if you want to get your loan from that bank, you're welcome to do so. You can go wherever you want. I am happy to provide you with names and numbers if you want to talk to various people. But if you work with your your smaller bank, you're not going to have access to as many products and programs. It just isn't possible. So if you know you're going to put 20% down and go and do a conventional loan, maybe it doesn't matter. But if you want access to the majority of down payment assistance programs, you need to work with lenders that have access to those programs. So again, one of the biggest and most popular ones is the Minnesota Housing Finance Agency. You can get up to $18,000 in the form of a second mortgage that's used when you buy the house, and they provide the down payment and the closing costs, in excess of the $1,000 that you put down. So don't let money be something that holds you back. If you want to buy a house, you have stable employment such that you can qualify for a loan, and you have a decent credit score, we need to talk. I can figure out a way or guide you to where, give you a number of ideas that might be helpful so that you can get into home ownership if that's what you want to do. So again, MHFA is one of the biggest, and you can see here, look at their income limits, up to $185,000. So they work, under the majority of people's income. So don't think that you don't qualify because you just might. Now, this is the new program. It says coming to Minnesota in 2024. It's here. And there's two versions. It's the first generation home ownership program. So let's take a look at that. There's two versions. The first version is the 100 million, and the second version is the 50 million. One is 32,000, one is 35,000. And again, you can see that they're forgivable at different rates. So if you're going to be there 5 years under the $32,000 program, if they forgive 20% a year, that means it's all forgiven. So 5 years later, you have an instant equity position of $32,000 under the community fund program. So really very popular. And as a matter of fact, right now, they've actually suspended, because it's so popular, they've suspended it while they clear out their pipeline. And then they're going to allow it again and after they catch up. So I have a buyer right now that's waiting for that money. And we're still looking, because if they find the right home, before that money reopens up, they're going to use the other program. It's just that the forgiveness terms under the other program you can see are half at 10 years and half at the 20-year mark. So the first program is really the one you want to go for if you can, because you may not be in that home 20 years, but you're very likely maybe could be there 5. So it's easier to project and easier to get that free money with the first version over here, the community fund. So I work with a couple of different lenders that have access to this. So my wife does not over at Wells Fargo, but my friend Pete Moy at Nations Lending does, and he works with all of the down payment assistance programs generally that are available. And another gentleman named Preston, and he's over at Movement Mortgage. So these two guys could help you with this down payment program or another. They also have some access to some proprietary programs that only they have access to. So they're big companies, big lenders that do lots of money and have access to lots of programs. So if you work with a mortgage broker, which we used to have a mortgage brokerage, so I'm partial to them, I think they're great. make sure you work with a mortgage broker that has access to the program that you want to use. Not all mortgage brokers can do this program. So you're only going to learn what you're going to learn either from your real estate agent or from your lender. Now, I want you to use the best program or best programs that are out there. So you can use whomever you want. I just gave you 3 lenders. I could give you more, but here you have 3 to choose from that I think would do a great job for you, depending on what type of loan you want, what type of down payment assistance you may need. So again, this is the biggie, the 100 million forgivable over 5 years. This is the big one. Okay, so types of mortgages, we talked a little bit about it already, but you have a conventional loan where everybody is eligible. FHA, everybody is eligible, and VA is for veterans. Now, a lender may have a different set of guidelines, or what we call overlays, that they put over the programs. So for example, FHA doesn't have a minimum credit score technically. However, you're going to find when you talk to most banks that they're going to be 620 to 640 for a minimum. Some will go down below that, let's say 580, but you're not going to be able to put 3.5% down. You're going to have to put maybe 10% or more down to lessen the risk to that lender. So if you had a situation in your life where life happened, and the more life you live, the more life will happen. So you have a ding on your credit report. It could be, job loss, medical, divorce, all sorts of things, that happen to people. And so if you have a ding on your credit, we'll either work with you to get it fixed and stay with you until you are eligible based on your credit score, or there might be a workaround with a larger down payment with a different lender that can broker to FHA, for example. So just options, and that's what you want to do is you want to present the way you are, and then we want to then match that to the best option. Conventional loan is insured by a private mortgage, and a private mortgage insurance company if you don't put 20% down. So if you were to default, for example, on your conventional loan, the lender then would turn your loan back to the private mortgage insurance company for reimbursement of a portion of their loss. FHA is the same way. It's a government insured loan, and if you were to default, then they would foreclose, and then they would give it back to FHA, and FHA would sell that as a HUD home, and then they would make the lender approximately whole. Again, there's a level of coverage, but Fannie Mae, Freddie Mac, those are conventional loans. FHA is FHA, and that's the Federal Housing Administration loan. And here we go, FHA, Federal Housing Administration loan. It requires mortgage insurance, typically that stays on forever. I say typically because with a larger down payment, it may stay on for 10 years, but generally plan on your FHA mortgage insurance premium to stay on for the length of that loan, whereas private mortgage insurance with a conventional loan can be removed oftentimes after 2 years, or you've paid it down to 78%. So there's different rules, different lenders, different programs, but with a conventional loan, you can get out of your mortgage insurance generally at some point, not so much with FHA. So here's kind of the benefits of FHA loans. You can get in with 3.5% for a down payment. Most lenders have a 640 minimum credit score. Now remember, you could add the Minnesota Housing Finance money with this and get in for as little as 1,000 of your own, and then the balance, that 2.5%, is going to be covered by that MHFA loan. Credit scores as low as 500 with a 10% down. Not all lenders will do that. Most lenders won't, but I do have outlets that will, so I could give you the names of those lenders. The seller is allowed to pay up to 6% of your closing costs. Now, they generally won't pay that much, but they're allowed to. So we could wrap in more of the expenses that you're incurring in buying that home within that transaction. Conventional typically is limited to 3%, and VA limited to 4% where the seller can pay. Low FHA has generally low mortgage rates. And for example, your credit score kind of depends, or the pricing of your conventional loan is tied somewhat to your credit score. The Lower your credit score, the higher the rate and the higher the private mortgage insurance. FHA really isn't like that. It's kind of uniform. So you could be a 850 credit score or a 640. And generally speaking, the rate's going to be very close, if not the same. So you're not rewarded as much for great credit or penalized as much for bad credit or lower scores with FHA. You can do 15, 30-year or an ARM, and down payment assistance works really nicely with FHA. Here's kind of another graphic comparison. If you have good scores with conventional loan, you can get into home ownership for as little as 3% down. FHA, it's 3.5%. Credit score range 500 over here as low, it's possible with FHA, and a 620 to 640 with a conventional loan. Debt ratios are usually up to 50%, which means that once we look at your income, you're allowed to use approximately half of it towards a house payment and your debt. Loan limits, are about 500,000 for FHA, which covers the majority of homes in the metro area, as well as conventional 726. There is no income limitation. You can make $1 million or more, whereas some of the down payment assistance programs do have income limits. Minimum out-of-pocket contribution. Well, you can get your down payment from a gift if you want, a 401k loan, a down payment assistance program. So there's all sorts of different ways we can figure out where to come up with that down payment, and sometimes we'll combine them. First-time buyers lack the money, but I just told you different ways that we can overcome that. And you can get gifts from parents or relatives. 401k loans, you're generally allowed to take up to 50% or $50,000, whichever is less. And if you have an IRA, you can take a distribution of $10,000 before age 59.5 and not claim it as, not claim it penalty, but you still have to claim it as income. Here's what you can't use for a down payment. You can't use borrowed money, credit card cash advances, or a loan from anyone other than the lender itself or a down payment assistance program. And you can't have mattress cash. So some people have a lot of cash at home just hanging out. You've got to get that in the system, which means you got to get it in a bank and you got to have it there for at least 2 months prior to starting your loan process, because what they ask for is a 2-month average balance in your account. So if you put the money from your mattress in the bank the month before you make the loan application, all of a sudden we have a problem. They want to know where that money came from. So you do need to introduce it into the system at a minimum of 2 months prior to starting. A buyer's eligibility is based on an underwriter review. That's why I think it's so important to get underwritten up front, because there can be variables. Now, I don't know if there's anybody that works like as a nurse and works a 0.8, for example, but we just had a problem with that with one of our lenders because they considered it variable income, and Fannie Mae and Freddie Mac want full-time income, not variable, even though 0.8 is really considered full-time work for many nurses. So we just ran into that. We did overcome it. We had to switch lenders, but just know that that's why getting underwritten is so important, so that we don't have anything blow up your deal when it might have been avoidable up front. The underwriter is basing your ability to repay based on your income, also your willingness to repay, and that's your credit history. So if you've always paid late or never paid, what's the lender to believe you're going to do in the future? Probably more of the same. So you have to show that you are capable of borrowing and repaying, and that you've done it in the past. Now, if you don't have credit, we want you to start building credit. And I can give you some different ways to do that when we speak, if we speak later. But you do want to build a credit profile and have active, usable credit so that they can see how you pay. And then the loan is based on the home. So you can't buy a scratch and dent home that's in disrepair unless you use a rehab loan. You're not going to be able to do that with standard, regular, conventional, or regular FHA loans. Now, both conventional and FHA have rehab loans. but they don't have, the regular loans won't allow you to buy a fixer-upper, if you will, that's in pretty fixer-upper condition. Okay, well, let's open it up real quick to questions and answers. Are there any questions that anybody has right now? You can drop me a quick, I'm gonna unmute. If you do, let's see here. Any questions that anybody has? I'll open up chat. You can send me a message in chat, or you can unmute if you'd like. I'll give it a minute or so. If there aren't any questions, we'll continue. Okay, it doesn't look like we have any questions at this time, so I'll put everybody back to mute. And then we'll continue. So here we go. All right, mistake number 2, not getting pre-approved before you view homes. So remember, we just kind of talked about what the pillars of a mortgage approval process are. Their credit, income, down payment. We can help you with the down payment through the different programs. Your income is what it is. Some of them, if you're self-employed, require that you've been on the job for a little bit, generally a year or more, and that you file the tax return. So if you're self-employed, don't let that completely discourage you. It just means a little more work on your part with gathering documents and maybe getting some letters from your CPA or maybe even a co-borrower. But I'll help you overcome that. And then credit, if you don't have credit yet, let's start building that credit either with secured cards, secured loans, maybe getting a companion card from a parent or a relative or significant other that, you know, they issue a duplicate or a companion card that'll report on your scores. So the nice thing about credit is that it's not forever, meaning if you have had a bump in the road, it's not going to follow you around for the rest of your life. It might follow you around for a couple of years until you rebuild it. Sometimes people don't understand credit, make some mistakes, and you can bounce back. Pre-qualification, we're trying to determine how much you can afford. That's again based on your credit, your income, and your assets. Pre-qualification can help you determine what amount of a house you can qualify for so that we can create the search accordingly. And then oftentimes what I'll recommend is that you get qualified for the maximum, even if you don't want to spend it. So let's say you're comfortable at a payment of 300,000, but the lender said you're qualified for 350. I would get your pre-approval letter at 350 and we'll set up the search based on 300. But let's say all of a sudden that perfect home is available for 310 or 320. If your letter says you're approved for it, you can make an offer. In a fast market where good homes go quickly, you're going to need to have that letter that in order to submit of at least what you're submitting your offer for. So if you're submitting it and it's, let's say your pre-approval is only for 300 and you want to offer 320, it doesn't look like you can buy it. You'll have to get another letter, and depending on the time and where your mortgage person is, we may or may not be able to get that in time. So it's just easier for everybody to start with the strongest letter and to use that as we go. Okay, loan pre-qualification. Tips for a simple loan approval. Call us, of course, if you have any questions. And one of the things I do is sit down with everybody and we walk through your plan so that we can plan accordingly. You want to continue to live at your current residence and pay as if everything is still the same. What the lender doesn't want to see is that you've gone out and added additional debt or things have changed, whether it be a job or an income, unless your income is increasing. They don't want to see a big variation or fluctuation in your income. So you don't want to work less while you're looking for a home because that'll impact your ability to qualify. They don't like to see large balance transfers. They don't like to see any new things like you go out and buy a new car, take out a car loan, because that affects your debt ratio. And your debt ratio affects how much you can qualify for. So basically, when you're starting the home buying process, you're keeping everything kind of static. You're not adding a lot of variability. Pre-approval that is underwritten again is the best because everything has already been reviewed. And sometimes things come up and we have to write letters or get documentation, maybe a letter from your employer regarding your employment. That can take some time. So we want to do all that in advance if we can, rather than in that 45-day window before we close, because we might not make it, meaning we might run out of time. And if we do, the deal could fall apart and you could lose your earnest money. So we want you to be the most solid buyer you can be, which means take that few extra weeks and get fully underwritten prior to moving forward and buying a house. The process will be much less stressful if you do it that way. The pre-approval with a guarantee allows you to shop with confidence, because you know there's not going to be a problem as long as the home appraises and the title's clear. So it's a great stress relief for you as well. We'll set up your search based on what you can afford. And I mentioned getting the strongest letter that you can so that you, as a buyer, are represented as the strongest buyer that you are. And by eliminating the underwriting process up front, you can close in as little as 2 weeks. And we eliminate surprises. And nobody likes surprises during the mortgage process, I promise you. Okay, mistake number 3, choosing the wrong lender. Well, we've talked about that a couple of times. Not all banks work with or are approved to use down payment assistance programs. So if you intend to use down payment assistance, the choice of your bank or lender broker is very important. Smaller institutions are smaller and have limited options. That's just the way that it is. The larger banks, the Wells Fargos, the US banks, the larger brokers, the Movements, the Nations Lending, they have access to most products. And that's where I would encourage you to take a look. Small banks don't offer generally the down payment assistance programs. Unfortunately, I had a client that was very loyal to her credit union and could have bought, let's say, in the year in which we initially started looking, but wanted to not leave her lender, and therefore she had to save up for the down payment. She didn't want to use the Minnesota Housing Finance Program, and home values at that time were going up at 10% a year. So you're buying a $300,000 home this year. Next year, that home costs you $330,000. So she saved up the down payment, and we ultimately did help them buy a home, her and her husband, but it cost them more than they needed to because they had to wait an extra year because they wanted to stay with that lender. So just know that there are options that could get you into home ownership sooner. We'll go wherever you want to go get your money, but there are advantages to using certain lenders. Okay, it's all about balancing the situation, finding the right home, the right payment that you can afford, the right lender, the right mortgage product. And that's where you need guidance. Again, I've been doing this 39 years. I've been guiding people for a long time, and I would love to help you. But if you don't work with me, I would encourage you to work with somebody that has been around for a long period of time so that you can get some seasoned advice. Unfortunately, there are a lot of part-time agents and people that don't have the depth of transactions. And honestly, I don't feel you're being represented as well by somebody that doesn't have that experience, because you're going to buy 3 to 5 homes in your lifetime. You just aren't going to do it enough to be an expert. If the agent helping you hasn't done much more than that, let's say your friend that just got in the business, they might be a great person, but how can the blind lead the blind? And that's especially true with rental properties. So I'm a landlord. I've been managing properties for my family since I got out of college, so since 1986. But many agents have never owned a rental property. So how could you consider buying or getting advice from somebody that's never done what you want to do and you've never done it either? So if you're buying rental property, I'm going to really encourage you to only work with somebody that's actively owning rental property so that you can get the right information. Okay, is a 30-year fixed mortgage always the right answer? Well, it all depends. Are you going to be in that home 30 years? What if you told me that, hey, John, I'm only going to be in Minnesota for 5 more years, then I'm moving to Florida, Texas, or wherever your state of choice is or country. So if you're going to move and you know you're going to move because your job is going to put you, maybe you're on a management track or something that has you moving, to different areas, then maybe you want to look at an adjustable rate mortgage. And the way they work is that you're fixed for a period of years, let's say 5, 7, or 10 years, and then it adjusts. It's still a 30-year loan, but the payment will be variable, i.e. adjustable rate. It'll adjust after that initial guarantee period. So an ARM is a great product if you want to get maybe a lower rate for a shorter period of time of your ownership. All depends on the day. Some days 30-year money is priced better than ARMs. So it's just something I want to make you aware of so that when you're doing your shopping, you look at both and then you make the right decision. Now, I'd mentioned rehab loans. So there's the FHA 203K and the Fannie Mae Home Style. There's a Freddie one as well. So there are programs that allow you to borrow the money to do the rehab at the time of the purchase. And what happens is that money goes into an escrow account. You typically have your bids up front, so you know how much to escrow. Then the work is done and the money is released out of that escrow. So maybe you found the perfect home in the neighborhood you want to be in, next to the family, friends, or school, or whatever it might be, or work. But you hate the kitchen, or you hate the bathrooms, or it needs a new furnace. And you're like, well, I would buy this house except for. That's where a special rehab loan could come in really handy, meaning you borrow the money for that rehab. Maybe it's going to cost you $30,000 to redo the kitchen. You borrow that up front. So maybe the home purchase is 300 just for a number. You borrow 330, and then that 30,000 is used to do that rehab of that kitchen. So now you get the home you want, the area you want, and that new kitchen that you want. So that's what a rehab loan can do for you. Now, again, that subset of lenders that are going to do rehab loans is very small because it requires a lot more work on their part. They have to manage the escrow. You have to get two appraisals. There's more work involved. So they would prefer not to do those, but those are available. So I wanted to make you aware of that in case that's what you run across. Know that there is an outlet and a loan type that might help you. You don't want to work with a data bank of people that are on a 1-800 line, like you may see. I won't mention names, like Rocket Mortgage, or some of the other lenders that are online where they don't maybe have the same level of competence maybe that people that have been out in the world. The mortgage world really does have a lot of seasoned veterans. I know Pete and Preston I believe Pete's been in it almost 15 years, Patty 25 years, Preston I think 10 years. So you really want to work with people that have done, just like with your real estate agent, with people that have done enough transactions and are aware of the products so that you can get the best advice. If you just call the 1-800 number or log on online, I can promise you that's probably not a veteran and you're not going to have the same experience. Mistake number 4 is buying from a builder without realtor representation. So the cost of buying from a builder and buying with an agent where you have representation is the same. When we set up the MLS search, let's say you wanted to move out to, let's say, Corcoran. Well, there's a lot of new construction out there because they have a lot of farmland that's being converted. So in your search will come up the various builders. It could be M&I, it could be Lennar, it could be Robert Thomas. It could be any number of, I know those 3 are building out there, but it could be others as well. And you say, hey, John, let's go see that house. Let's go look at that new construction. Absolutely. We set up a time. We go during the model hours. And what we do is we register you as a representative, as your representative at the time that we walk you into the home. As long as we do that, everybody's happy. If we don't do that, let's say you go out on a Sunday, you drive around and you go in and you register. Now we have maybe a little bit of a problem because they were there and they represented you first. Even though they're representing the builder, they registered you. And what they don't want is just a random agent coming in saying, well, I represent these people, pay us a commission. They want to know that we were responsible for bringing you to that house, whether it's from the product of the search or whatever, but they want us to accompany you on that first visit. So if you're working with an agent, new construction is something we absolutely help you buy and sell. We just have to register you with them initially. So please let us know and we will accommodate your schedule to get you in and walk you through. The nice thing about having an agent in new construction is we can make suggestions on things like lots, floor plans, color packages, and other things that you might not have thought about that the builder rep might not tell you about, because who does the builder represent? Well, it's sort of in the name, isn't it? The builder. That's why they're the builder rep. They don't represent you. And so how can they represent both of you equally? Well, they can't. So they're going to represent the builder. And not that they aren't great people and help you make good decisions, but there might be something that they're not going to guide you towards or share with you that your agent, if you have representation, would have. We also can help you do the comparison between the builders. So many times, if you identify an area like, let's say, Corcoran, we're going to run through all the builders and then based on your price range, help you choose which one is offering the most value. Sometimes they offer specials. Sometimes they offer mortgage incentives if you use their mortgage people. So all of those things go into the equation of what's the best deal for you. And that's what we can help you do. So it says the truth about buying directly from a builder, many of them will offer specials to use their mortgage company. And the reason they do that is they want to know that if they build you a home, that that home is going to close. And they trust their mortgage people when they say this buyer is approved. If you come in with another mortgage lender approval, they may say, well, I don't know, start to build a home and the deal falls apart. Now they're sitting on a spec home. We just had a question. How does the Zillow agent showing work? If I go to a house showing off a Zillow, is this representative now my agent? The answer is no, that agent is not your representative unless you signed a representation agreement. Now, one of the things that the Zillow agents and other agents can do is offer you a showing only arrangement for 7 days. So what that means is you call up the agent and you say, I want to see it. And then the agent has to present you with the agency forms that we looked at initially. They also are going to talk to you about representation. And you may say, I only want to be shown this home. I don't want, at this time, I don't want representation. And they may agree to do that. They may not agree to do that. They may say, no, my business model is if I'm going to drive over there, you will have to sign an arrangement with me. But they may be willing to do the showing first, kind of try before you buy. And then if you like each other and you feel like you'll be represented competently, then you could enter into a contract for representation. But that's one of the things that the lawsuit requires now, is that we have a signed agreement of some sort. But that signed agreement could be just a showing arrangement. Doesn't have to be a representation agreement right off the bat. I would say, if you work with an agent, you should work with, if you're under contract, you only can work with one agent for representation. We can show you everything that's on Zillow. So what Zillow does is redisplay the MLS data. So Zillow takes their home data from the multiple listing service. Zillow is not a database of homes. Zillow is redisplaying the multiple listing service. So Zillow doesn't add any value, in my opinion. If you have an agent that you're working with and you have a search set up that meets your parameters, you're getting in your search all of the listings that are also on Zillow, but you're not getting it from the source. You're getting it through Zillow. Zillow is primarily, in my opinion, a advertising outlet that sells leads to agents. So you'd mentioned, what about the Zillow agent? So when you go to Zillow, they have the home, and then it says, here's the listing agent, click here if you want to talk to them, or here's 5 other agents. The 5 other agents are paying for their positioning and display. So the guy or gal on the top is paying the most because they get clicked the most. The person at the bottom gets clicked the least. Zillow is in the market of selling those leads to the agents because the agents want to meet new clients. So Zillow, I tell people, you can go there if you want, But if I have an MLS search set up for you, you're not getting any additional information. As a matter of fact, you're getting sometimes outdated information. So Zillow by design wants to sell leads and get clicks. Therefore, Zillow does not update real time as quickly as the MLS. So you may see a home on Zillow and you're like, well, how come that one isn't in my search? Well, that's because it sold 2 weeks ago. And Zillow hasn't removed it because Zillow wants to keep the data there so people click on it and that a conversation can be engaged with an agent. Did that answer your question, Yaha? Okay, I'll assume it did. If it didn't, type me some more information in the chat and I'll be happy to go deeper. Okay, yes, thank you, he says. Okay, super. So a realtor at the bottom here is knowledgeable what to look for during inspections and a walkthrough and upgrades. And so realtor representation, your realtor representation, I think is important, and it won't cost you any additional money to have that representation. If you have a agreement with your agent that says the agent will work with whatever the builder is willing to compensate them at. So it won't cost you anymore, and I think you'll have a better, at least represented experience. Mistake number 5, skipping the home inspection process. Okay, first thing I'll say is I will never tell you to skip a home inspection, but I will tell you when it might be advantageous to you and when you may want to consider it. For example, if you're buying new construction, that new construction home has to get what's called a certificate of occupancy, which means the city has signed off on it. Well, the city won't sign off on things that aren't up to code and that don't meet code. So as the home is being built, they go through, check the framing, check the plumbing, check the HVAC. They sign off on it. So to have a new construction home inspected by a private home inspector for $500-600 might not be something that you want to do. I'm not telling you not to do it. I'm just telling you might not want to do it because it might be redundant. Another time that you might want to consider whether or not you want it is if you're in a multiple offer. So the 3 multiple offers we received this past weekend on that home I mentioned in Crystal, one was 10 days, I think one was 7 days, and one was 5 days. That was the length of time that they wanted to complete their inspections. The one that did 5 days also happened to be the strongest offer, so it was perfect. They had everything right. They had the down payment, they had the price, and they had the shorter inspection. So that's the one we went with. But what an inspection does is it creates a contingency. So the people today had a sewer cleaner come over, Ron the sewer rat, come on over and check the main sewer line out to the street. What if, and I don't think this is going to happen, I'll check my email when we're done, but what if after today they decided they don't want to buy the home? Well, they can back out because it's 5 days to do their inspection. We're within that 5-day timeline. More likely, what would happen is they would come back with, you know what, this is going to cost me X amount of money, and this is something that none of us knew. However, it's a hazardous item or it's a material item that now that we know we have to address. So in that sense, we maybe go back to the renegotiation table when there are things that are discovered that are material and let's say hazardous during a home inspection. Okay, so the risk of skipping an inspection, if you decide to do that, is that there may be a deal breaker. There could have been something that could have been discovered that isn't, and now you have to deal with it later. I call those money bombs. So if there's a money bomb and you have to deal with it, on your nickel because you didn't have a home inspection, there's no recourse. You lose your negotiating power if you don't have a home inspection, because you're accepting it as is. So later you can't come back to them and say, well, I didn't know, and I know you didn't know either, but none of us knew that the roof needed to be replaced. Well, at this point, there's nothing that can be done about it. So you don't get to go back after closing. So you could inherit problems that are structural, or things that, again, that you're not aware of at the time by not having an inspection. So inspection is sort of like an insurance policy, I would recommend it. And in that sense, you'll know your home better. You may not get everything covered right away from that home inspection because they're not going to rebuild you a new home, but they typically will address hazardous items. Okay, so mistake number 6 is skipping the condo documentation review. By law, from the Attorney General's office, you can go to their website and look at their publications. You have 10 days to review the rules, regulations, and bylaws that are associated with that project. And the reason that you have that time is you're now entering into a living situation where you're not master of your own universe, meaning you have to maybe have a common shared wall or walls. There are rules on pets, renting, noise, smoking, all of those things that maybe you don't want to accept. And that's why you're allowed to back out. So I had a buyer last evening. We looked at a property. It's absolutely perfect for her. However, she's a smoker, and that association has banned smoking on the premise. She also would like to get a dog, but that association prohibits any dogs. So even though the property fits her budget, is a perfect home, it's a great, great little property, the other two things are more important to her, the smoking and the potential dog. So our search is going to continue. We're not going to buy that house. But we vetted all of that before we made an offer. But if we hadn't, because that information wasn't available to us, let's say, in this case, it was available. We had a copy of all the rules, regulations, and bylaws in advance. But if we hadn't, then after we would have bought it, we would have gotten it, we would have reviewed it, and she would have backed out at that time. And she would have had 10 days to do it. In this case, because the documents were available up front, we didn't waste or tie up that property into any type of an inspection period or review period. If you go to the Attorney General's website, this is a copy of the document. It's 4 pages that goes over the statutes and the rules. When we set up a search, what we do is we log into the MLS, we save you as a contact, and then we set up the minimums based on what you would consider for home ownership. And we send that over to you initially with what's available today, and then ongoing what's available tomorrow, meaning new listings as they appear. Also within the MLS, under each listing, there's a little button that says down payment assistance for this house. So we can have you check up front what loan programs you think you want to use. And then if there might be another 1 or 2 that are specific to that location, maybe that neighborhood. For example, there are certain areas in town where they want to encourage more home ownership and less rental. And so they may give you more money or special money just to be within a couple of blocks, for example. And that would be discovered by a button that's underneath the listing within the MLS. So if that's the home for you, we'll find it and we'll look for the down payment. I have lots and lots and lots of resources that I want to share with you. This here is where you can get a PDF or review it online through a flip book of the PDF of the book Secrets for Successfully Purchasing Your First Home. I can mail this out to you as well. However, I need your mailing address in order to do that. So you could drop me an email, say, John, send me the book, and I would mail that out to you. This is the topics that are in the book: owning versus renting, needs and desires, getting that first home loan, first-time home buyer programs, common first-time buyer mistakes, searching for the right home, 12 steps to buying a home, hiring an agent or buy a loan, do's and don'ts of negotiations, what to know about home inspections, the closing process, moving tips for the first timer, and real estate horror stories. So that's what you're going to get in the book. I have another book, a PDF actually. This isn't a pure book, but it's another one, Building a Case for Home Ownership, and it compares owning versus renting. And then I have books on other topics, such as downsizing, real estate investing, and selling your home. So you might have friends or family that are not looking at buying or at least buying a first home, but have interests in other areas, and I can provide them a book or a online flip book as well. I also have a YouTube channel where I post interviews with various people that are in the home industry. So mortgage lenders, mortgage programs, other things that ancillarily might benefit you. You can go to youtube.com/the Minneapolis St. Paul Homes. Here's the QR code of it. So how do you feel now? Are you more knowledgeable? Do you feel better? You're excited, confident, informed, ready to start? If you would like to start and schedule a meeting, you can call me, or you can go to minneapolisstpaulhomes.net/book and book an appointment with me. So you might want to take an appointment or take a picture. That's going to allow you to pick a time through Calendly. That time may or may not work in my schedule, and then I will call you back and say, you know what, that works great. I'll see you then. We can do it in person. We can do it via Zoom, or if the time doesn't work, we'll pick another time. If you want to set up a search and start looking at homes, you can do that right from my website too, and that's minneapolisstpaulhomes.com. So you see the Calendly link is at a .net, and my website is a .com. This is what it looks like on Calendly. Of course, we don't discriminate. We want everybody to own a home, and we want you, if you can use some of these programs, we want you to use them. If you would like to take a 7-question survey, you could take a snapshot of this QR code. It's going to take you to the survey, and if you complete it, then I will send you a Las Vegas complimentary travel certificate. Now, there is a cost associated with activating. You can see over here on the left-hand side, there's a cost to redeem it, but it's cheaper than going directly to the hotel. And we love Las Vegas, so that's why I give out these certificates. So anyway, it's a way for you to take a cheap trip if you're interested. These are the terms and conditions which you would find when you go to the website when you redeem it. No timeshare, by the way. Okay, here is my card. Take a picture of that. And I'm going to go ahead and stop the sharing and open it up to questions. So if you wanted to unmute and ask me anything, I'm happy to answer any of your questions, or you can put it in chat, however you would like to do it. Monet, you've unmuted. Did you have a question?
Not really. It was very informative. I'll connect with you personally.
Okay.
You're a realtor, right?
Come again?
Are you a realtor?
Oh my gosh, yes. 39 years.
Okay.
Yep, I'm a real estate broker associate with Remax Results. Anybody else have questions that I can answer for you?
I have a question. So what if there's 2 people that are trying to buy the house?
Sure.
Do you how would you look at 2 people?
Yep. Your income, your debt, their credit, your credit, you become one on the loan application. Now, if that person has already bought a house, then they're not a first-time buyer. So that'll mess up potentially your first-time buyer if you need to add them. Now, if you don't need to add them, meaning your income and your credit, everything is fine, and we don't need to add that person, you could do it in your name first. And then after closing, you could run a deed from you to them or with them, together. So if you're in that situation where it takes 1 to buy and 2 to sell. So if you're married or involved or whatever, however that might be, only one person needs to qualify for that house. You both don't need to, unless you need to, meaning you need both incomes to get what you want, which is oftentimes the case. But if it's not the case, you don't feel like you have to do that. Sometimes it's better, especially if you're married, to live to fight another day, meaning if we go back to the foreclosure crisis world of 08, 9, and 10, many families had purchased and taken out a loan based on 2 incomes when they didn't need to. So all of a sudden they get in a foreclosure situation that affects both of them. They're out of the game. They're out of the market for 2 to 5 years, depending on their foreclosure, if it was a short sale or whatever it was. And now neither one can do anything other than rent. But if they had only bought in just one of their names, then the other one could live to fight another day and could immediately, one could get foreclosed on and the other could go out and buy a house the next day. So, because they aren't responsible for what the other one did. So that's why sometimes splitting credit is very valuable if you can do it from a life happens, let's protect myself. I have no idea what the future holds. Because sometimes, that happens. Did that answer your question, Chris? Okay, are there any other questions that anybody has? No other questions? Okay, well, I thank you all for coming tonight. If I can be of service to you or somebody you know, let me know. Wherever I can help, I want to help. And with that, I'm going to bid you good night. And I wish you well in your search, and I would like to be part of it if you'd like me to be part of it. So thank you very much.